what part of the world you are in, because we do get viewers from all over the world here for our training at the Mortgage Calculator. Today's training is on calculating non-variable W-2 income. And specifically, what we're referring to here is steady income, not commission, right? So let's get right into it because I do explain that all in the slide. So what do we mean by non-variable income, right? I was just talking about that. That is income with a predetermined amount that occurs with a regular frequency and it has a defined documentable term, right? So this is your salaried borrower, your hourly borrower, those that they work either 40 hours every week, 52 weeks a year. They're going to get paid either bi-weekly, which means every 2 weeks, or they're going to get paid either bi-monthly, which is twice a month, or maybe they get paid monthly, or maybe they get paid weekly, right? For this type of borrower, the way to document their income is going to be with pay stubs dated within the last 30 days of the initial application. W-2s are also usually going to be needed for the prior 2 years or whatever automated underwriting states. If your DU finding state you only need 1 year W-2s, then that's all you're going to submit with the loan. A written verification of employment. So it could be the pay stubs, W-2s, or you could provide the written verification of employment, either from the employer, or from a third-party vendor like the Work Number. And the verification is going to include the year-to-date income for the current year, plus the prior year's earnings, 2023 and 2022, depending what you are required to provide according to your automated underwriting findings. And then, of course, prior to closing, at least 10 days prior to the note date, you're going to need a verbal verification of employment as well. Now, in certain cases, we could have W-2 borrowers where DU may not state that you need tax returns, but the specifics of the case do state, or DU may state it depending on how it was documented on the application. But scenarios where tax returns will be required are going to be when the employee is employed by family, right? If they're employed by family, the guidelines are a little bit different on the for example, on the agency loans, right? It's going to tell you in that case to use the prior 2 years' income and not to use the year-to-date income. A little bit of a confusing twist there. But the reason that they say that is because they fear collusion between the borrower and their family member, right? Like they know they're going to get a house now. They need to bump their income. So they're going to ask to have their current income bumped up, which may or may not be a realistic income amount, may not be the actual one. So in those cases, if you are employed by a family member, they're going to look at the tax returns. They're not going to look at the year-to-date income. Year-to-date income will be looked at just to note continuity of the income stream, but that's not the income that's going to be used. Tax returns also required when the borrower is employed by an interested party to the transaction. So, for example, if the borrower is employed by the seller, and that does happen, somebody works for a company, the owner of the company is selling the house, selling a property they own. They say, hey, I want to buy your property. Sure, give me a chance. They buy it or put an offer on it. Well, that person is an interested party to the transaction, the seller, who also happens to be the employer of the borrower. So you're going to need tax returns for that. Same scenario with the pay stubs. Now, borrower that's self-employed, that's not, variable income. That's not non-variable income, but just letting you know that is a scenario where you're always going to require tax returns. Interest and dividend income also requires tax returns. Foreign income, in other words, income earned outside of the US that the borrower is declaring in their US tax return, also requires tax returns. And of course, rental income, right? Rental income is documented on the Schedule E, as in Edward, page 1 of the Schedule E, because page 2 of the Schedule E is where the royalties for corporate income go. Now, regarding the actual calculation of the income, this is super important because I find in too many cases that I'm reviewing files and loan officers are using just the W-2 income. For example, I ask them, how do you calculate the income? Oh, I grabbed the last 2 years W-2s, averaged it out, divided by 12, and that's my income. I mean, that's okay if you were looking, for example, a borrower employed by family, and that's what the guidelines tell you to do. But that's not how you would normally calculate the income, non-variable income for a salaried or hourly employee. You would use the year to date income. That is the accurate depiction of what the borrower is earning right now at this point in time, right? So if they are not employed by family or by an interested party to the transaction, and they are a salaried or hourly employee, then you would not use the W-2s, you would use the year to date income. Now, you still do look at the W-2s for the continuity of the income, meaning, for example, if they made $60,000 in 2022, and $61,000, let's say, in 2023, but now in 2024, you're almost at the end of the year, and it doesn't look like they're gonna make the same amount. It looks like they're, $10,000 less in the year-to-date income. That's gonna be an issue because now you have a decline in income. So that's why W-2s are looked at as a benchmark, and then you look at the year-to-date, and if it's the same or more, you're good. If it's less and you have declining income, depending on the percentage of the income, is going to be the severity of the impact to the deal, right? So, how do you calculate the income? Well, the first thing you would do, and this is now one of the assumptions here, of course, when you're looking at this, is that the borrower started working at the current employer on January 1st, hasn't missed any time, right? So you're going to base it on accurate amounts there. If the borrower started working after January 1st, then definitely a written verification of employment is going to be required to confirm when was the actual start date. You're going to see how many months have elapsed from the start date to the current pay period, and that's how you're going to calculate the year-to-date income, right? You're going to establish how many days in the year have passed, right? That's how you would calculate that. So in this example here, we're going to assume that the borrower started working on January 1st. So first thing, we have to determine the gross year-to-date income. So in our scenario here, we have John Doe, that his year-to-date earnings are $900, right? And so now, once you get the year-to-date gross income, you also got to note the following. And in some cases, these pay stubs can be a little complicated with sick days, paid time off, vacation, and other components of the income. So remember, overtime is a different category, but paid time off, sick days, holidays, and vacation are usually days that they got paid for when they did not work. And that usually means that the earnings for the hours worked or the salary is going to be offset by the vacation and paid time off and those other components there. So you have to get and add together the year-to-date earnings from their regular pay plus vacation, sick days, and other paid time off. to get a total amount. And then you're going to get that total amount, and you're going to divide it by the number of day by the time that has elapsed. So, for example, in the calculation that I did there, I calculated that we were in June 16 pay period, which is what it says there on the pay stub. Pay period is 6/2 of '06 to 6/16 of '06. So that means that that is all the earnings that John Doe has earned through June 16th of the calendar year. So now we get 16 days that have elapsed in the month, because the pay period was through June 16. That's how much money he made through June 16. So we get the 16 days, and we divide it by 30 days, because there's 30 days in June, and that gives us 0.5333, and it's actually 0.533 repeating into infinity. So I just cut it off at the fourth decimal point there, and then you get June. So June 16th in numerical terms is represented by the number 5.5333, because there's 5 months have elapsed through May. All of May, January, February, March, April, May are complete, and then we got partial has elapsed of June. So 5.5333 is the numerical representation of June 16th. So then you get the year-to-date income, since our borrower has been working since the beginning of the year. So our year-to-date income is $900, and we divide that by 5.5333, and we arrive at our monthly income of $162.65. So that would be our calculation for the actual year-to-date income through 6/16, in this case, let's say 2024, right? You would not, okay, I repeat, you would not get the number of hours times the pay rate, right? You would not multiply that, and then assuming that he gets paid, in this case, he gets paid every 2 weeks, right? So you would not get that figure, multiply it times 26, and divide by 12. That's not what you do. Now, you could do that if you want to establish some type of a benchmark, like what would he have earned if he worked 40 hours every week, because borrowers simply sometimes do not work 40 hours every week in the whole year. There may be a pay period where they work a few less hours. Maybe that's because of vacation, paid time off, holidays, whatever it may be. And that's where those other categories may come into play. So if you want to do that calculation just to confirm what it would be in the ideal scenario to see if you're over or under in your year-to-date calculation, but only use that just to compare, because that is not the income, because you cannot assume that the borrower worked 40 hours every week of the current calendar year, right? If you do, you're going to be off, especially if it's a borrower that you see that has a lot of vacation and paid time off and other components there to the pay. He probably has been in training on some other days as well that he didn't get paid for on the hourly, got paid for through the training cost code. Let's just put it that way. So really important, year-to-date income is the key. And we only use the W-2s to confirm the continuity of the income to see if it's the same or if it has declined. So that's it for calculating the income for non-variable income borrowers. I'm going to give it a minute to see if there's any questions. I know I was pretty detailed and thorough on this, but just want to see if there's any questions. Nope, no questions from anyone. All right, so I do look forward to seeing you in tomorrow's training. Thank you and have a great day.